Good evening, everybody. Tonight we have the pleasure of having Mr. Jeffrey Kennedy with Elliott Wave International join us. Jeffrey, I'm not going to take up too much of your time, and we look forward to your presentation this evening.
Okay, excellent. Hello, everyone. Happy Thursday evening. Thank you for sharing your evening with me. I really appreciate that. The format I'm going to basically stick with tonight is probably about a 35-40 minute presentation. And then after that, I would like to actually open the floor to some questions. But before I get too far into tonight's presentation, I just want to make sure everybody can do just a final sound and audio check. Make sure you can hear my voice okay and also see the cover slide, which is simply the title of tonight's presentation. Okay, excellent, excellent. Okay, well, as Becky said, I work at Elliott Wave International. I've been with the company for almost 25 years now. My primary discipline in the field of technical analysis is the Elliott Wave principle. So whenever I'm approaching a price chart, I tend to look at it through the lens of an Elliottician. But also as a professional technical analyst, I also understand that the field of technical analysis is very rich and diverse. And what I mean by that is there are many different disciplines within the field of technical analysis. There are many different tools that as technicians we can actually employ to not only improve our forecasting but also our trading capabilities. So my approach to the market, even though I am an Elliottician, is one of, it's a very holistic approach. I utilize the wave principle as my primary, but I also like to include different other tools and disciplines, primarily like indicators and oscillators. My favorite two are probably RSI and stochastic, and then of course Japanese candlestick analysis. Japanese candlestick analysis, in my opinion, is very, very important. And just to kind of give you an idea of exactly what I'm referring to, I utilize the wave principle to really provide, say, a context for a specific market. And then with Japanese candlestick analysis, I'm actually able to zero in on a specific price action, many times analyze, as you well know, the strength of the bulls or the bears in a single price bar. More importantly, it also gives me, allows me to identify very specific levels to actually trade against. So what I'd first like to do before I start is go ahead and hold on here, I may have a problem. Okay, there we go. I'm sorry about that, guys. We are having technical issues this evening. Well, first off, I'd like to get everybody on the same side of the fence. And exactly what I'm referring to with that is just cover the five core foundational patterns of the Elliott wave principle. Now, the first pattern we're going to look at, this is referred to as an impulse wave. And what's very important initially to understand is the wave principle classifies price action into different what we call modalities. We have motive waves, and then we also have corrective waves. There are two types of motive waves, and that would be the impulse wave, which you can see in front of you. And then we also have corrective wave patterns. We have a zigzag, flat, and a triangle. I'm going to show you exactly what each one looks at or looks like, because whenever, as an Elliottician, when I'm looking at price charts, essentially what I'm looking for are these specific patterns. Everything else we know about the Elliott wave principle stems from these five core patterns. This is an impulse wave, and as you can see, we have an initial rise here for wave 1. This would be the initial counter trend move. This would be our wave 2 pullback. Then we have wave 3, wave 5, and each move, waves 1, wave 3, and wave 5, those are our impulse waves. Those moves are going to subdivide into 5 smaller structures. Our counter trend moves are going to be waves 2 and also wave 4. Now, the second type of motive wave pattern is that of an ending diagonal, or what we sometimes refer to as simply a straightforward diagonal. If you're familiar with old school technical analysis, say Edwards and McGee, it's referred to as a rising wedge. Now, to an Elliottician, this is a very important pattern because it only can occur in the fifth wave position of an impulse wave or as wave C of an ABC, of either, a zigzag and or a flat. So These are the two primary motive wave patterns we work with, the impulse wave and also the diagonal. Now this structure here, the next slide I'm going to show you, this is what we refer to as a zigzag, probably one of the most popular, if not the most popular, counter trend or corrective price move you'll see. And you'll also notice by the name, the zigzag, that's what this pattern is referred to. I have the notation of 535. Essentially what that means is that wave A subdivides into 5 waves, wave B subdivides into 3 waves, and wave C also subdivides into 5 waves. Now what's going to be very important, one of the things that I consider to be very important about the counter trend moves or the corrective wave patterns is that they tend to be contained within parallel lines. Very, very important. Counter trend price action tends to be contained by parallel lines. And this is a great example of just that. Again, this is a zigzag. It's a 5-3-5 structure. Now the second type of corrective wave pattern is the flat. This is referred to as a 3-3-5 pattern. Notice that wave A subdivides into 3 waves, wave B subdivides into 3 waves, and then wave C, of course, unfolds in 5 waves as well. Now, it's important to understand that each pattern that we are discussing has very specific rules and very specific guidelines. And if you'd like to learn more, there's plenty of material at EWI or ElliottWave.com, a lot of free material that you can look at to kind of get an idea of the rules and guidelines which actually govern each pattern. Now, the final pattern we're going to discuss is the triangle. This is a 3-3-3-3-3 pattern, and this simply means that each wave subdivides into a 3-wave structure. Specifically, it's going to be a zigzag or a variation of the zigzag. So what we have here is a triangle. Now triangles, again, as an Elliottians, we have rules and guidelines which govern wave pattern development. So a triangle can only occur in certain wave positions. Specifically, it can only occur by itself in the wave 4, wave B, or wave X wave positions. Very important to remember because each one of those wave positions actually precedes the final move of a sequence. So to just sum it all up, let me go to another page here, and I'll show you another slide that actually summarizes everything that we've discussed. And give me just a moment here. Load the next page. And I apologize for the delay. I've got a lot of slides here, and there seems to be a little bit of a delay with the transition. There we go. This is the slide I'm looking at. So everything that we've just discussed is summarized in this one slide. These are the 5 core Elliott wave patterns, and again, everything that we know about the Elliott wave principle as Elliotticians when we're looking for patterns, this is primarily what we're looking for. Now there are variations to some of these structures and some of these formations. For example, a common variation of the flat pattern is an expanded flat or a running flat. A variation of the triangle would be that of, say, an expanding triangle or maybe a barrier triangle. Now, before I get too far along in the presentation, are there any questions so far? This is again, a very basic introduction to the Elliott wave principle and the 5 core or foundational patterns that we work with. Any questions thus far? Okay, I don't see anybody responding, so I'm going to assume that nobody has any questions. Does it apply to all time frames? That's a question. Bob, yes, it does. I utilize the wave principle quite successfully on the intraday time frames, 1 minute, 3 minute, 5 minute price charts, and also 2 on the larger time frames as well, daily, weekly, and also monthly. Okay, what is the difference between impulse and diagonal? Well, if you look at this diagram right here, you'll see it's a 5-wave move, but wave 4 does not end in the price territory of wave 1. That is a key characteristic of the impulse wave. The diagonal, on the other hand, well, each one of the moves, the waves 1, 2, 3, 4, and 5, each one of those moves subdivides into a smaller 3-wave structure. Also, too, within a diagonal, you'll definitely be able to put the converging trend lines on, and also, too, wave 4 is expected to terminate below the wave 1 extreme. The primary difference between these two patterns is that the impulse wave tends to denote the direction of the larger trend, whereas the diagonal, again, this is a terminating wave pattern that you typically find at the end or as in the fifth wave position, for example, right here, of an impulse wave, or as, say, for example, wave C of a zigzag. Is the, well, it's not a barrel triangle, I'm sorry, it's a barrier. It's a barrier triangle. Is that called an ascending or descending wedge? Yes, that was the old terminology that the Elliotticians used to use. Can we apply it to Forex? Absolutely. That's one thing that's very important I've learned over the years as a technician. And I have a very small, say, trader's toolbox. And when I refer to my trader's toolbox, I'm referring to the different techniques or approaches I use to forecast markets and also trade with. In that toolbox, very few tools, but those tools are reliable. And the reason those tools are reliable primarily is because they must work on any market in any time frame. A specific tool that does not work on any market or any time frame, I really have very little use for. And of course, Fibonacci retracements, absolutely. Fibonacci is, well, in fact, Ralph Nelson Elliott, one of the works that he actually wrote in the 1930s, was a book referred to as Nature's Law. And in that book, he specifically states that the Fibonacci sequence is indeed the mathematical basis of the Elliott wave principle. Okay, MJ, here's a good question that may be relevant for a lot of people. As soon as I look at a live chart, I get lost and cannot see the structure. Simple trick. Put on like a 5 or 10 period simple moving average over price and utilize that to identify wave structure. Very simple trick, but what it will allow you to do is train your eye visually to the actual underlying substructure. Doug, well, we use letters and numbers to identify mode of waves, and we utilize letters to identify counter-trend structures. Now, here's essentially the money shot for the night. This is how I utilize Japanese candlestick analysis in conjunction with the Elliott wave principle. And I truly don't believe that they are two competing disciplines. In fact, I think these two disciplines, and when I say disciplines, I'm talking Elliott wave analysis and Japanese candlestick analysis. I think these two disciplines actually enhance one another, where I'm utilizing the wave principle to identify, say, for example, the larger context in a specific market. I can actually utilize candlestick formations to actually fine-tune the termination points of each of the individual patterns or sometimes each individual wave. Now, I'm sure many of you are much better versed at Japanese candlestick analysis than I am. Again, my area of expertise in general is technical analysis, but more specifically the Elliott wave principle. But as a practicing, say, Japanese candlestick enthusiast, that might be the better definition for how I know Japanese candlestick analysis, I really work with only maybe about a half a dozen to a dozen wave pattern candlestick formations. As you know, there are literally hundreds of different Japanese candlestick formations. I try and keep things simple, not only from an Elliott wave perspective, but also from a general technical perspective as well. I like things very simple, and over the years, I've come to rely on maybe about a half a dozen candlestick formations. For example, I'm sure this is very again, I'm sure many of you in the room tonight could teach me a thing or two about Japanese candlestick analysis, but here are some common ones that I very much put a lot of value in. Bullish engulfing pattern, of course, 3 inside down formation, piercing pattern, the opposite of which is the dark cloud cover formation. Then everyone seems to know the morning star structure, and of course we have a bearish engulfing pattern. So the way I utilize the structure, if you notice the numbers here we have waves 1, 2, 3, 4, and 5. Now this is just a diagram, but I just want to show you some examples, again, of how we can actually combine both disciplines, the wave principle as well as Japanese candlestick analysis, quite successfully. And again, I think both disciplines actually complement one another. Now here is a price chart I was working with for my, I actually edit two services or have two services at Elliott Wave International. One service is referred to or is called Trader's Classroom. The purpose of that service essentially is education. I spend about 80% of my time in Trader's Classroom teaching people about technical analysis and also the wave principle, but more importantly, the education is geared toward application. It's geared toward trading. And then I do about 20% forecasting on specific individual stocks. That seems to be most of what I do. I have another service that I call Commodity Junctures. And in that service, I do forecasting for many commodity traders, all my subscribers, in the commodity markets. And if we have time, I will actually look at a commodity chart. I have got one or two, for example, in sugar and soybeans that I think is quite interesting. But what we have here, this is a stock. This is Exelon Corporation, and the ticker symbol is EXC. And this is a wave pattern that we've been working with in Trader's Classroom for a few weeks now. And it's a great example of an Elliott wave impulsive move. Here we have wave 1 up, 2 down. Typically the most common Fibonacci retracement for a second wave is a 618 multiple of wave 1. Then we have our wave 3 advance. Common Fibonacci multiples between waves 3 and wave 1 tend to be 1.618, 2.0, or even 2.618. Then we have a contracting triangle fourth wave, which ends at or near, say, the 236 retracement of the wave 3 advance. Typically the most common Fibonacci retracement we see in a fourth wave structure is actually a 382 retracement of the wave 3 advance. However, when wave 4 is very time consuming, as it is here because of the triangle, then the retracement many times is actually shallower than a 382 retracement. Then of course we have the final fifth wave advance to just a little bit above 3649. This level is important because this level represents the point of equality between wave 5 and wave 1, and that adheres to one of the guidelines of the wave principle, which is the guideline of wave equality. So moving forward, my focus is to the downside. Now let's look at essentially this price action right here, our fourth wave contracting triangle, utilizing candlesticks. And here's the price chart of that. Okay, now what you'll see in this slide, this is the triangle we were working with, but notice how nicely the candlestick patterns, the Japanese candlestick patterns, actually fine-tune your focus into specific trade setups. For example, the 3 inside down formation right here. Notice the small real body which is encompassed by the prior candle, and then we have a larger candle break to the downside. This is a 3 inside down formation. Again, very significant chart, candlestick formation, but it nailed the extreme of our wave 3 top. Then we have our fourth wave triangle over here, which ended wave 4. 1 up, 2 down, and then I really like the bullish engulfing pattern here, which corresponded to wave 2 within the anticipated 5-wave advance. Notice the long lower shadow. As you well know, long lower shadows tend to identify areas on the price chart that the market is actually rejecting bullish engulfing patterns. So from a trading perspective, the way I utilize this in my own trading, many times I'll simply put in an order or actually buy a break above the upper shadow. Where would be my protective stop? Well, initially, the low of the shadow, the spike, or even maybe the low of the actual breakout bar right here, the subsequent candle. This is just one example. Here's another example. This was Groupon, and I'll wait for the price chart to load up so everybody can see this. Okay, this is a price chart of Groupon, and what we have here, this formation to the downside simply is a zigzag. It's a 5-3-5 pattern, but if you notice, I've got some trend lines identified within the wave C sell-off. Okay, this is referred to as the ending diagonal. Remember I told you previously that an ending diagonal is a terminating wave pattern that may only occur in the fifth wave position of an impulse wave or as wave C of a zigzag and sometimes a flat. Remember that. But this is just a textbook quality zigzag, nice impulsive advance to the upside, clear 3-wave decline to the downside. Fibonacci support definitely came into play, came down also 2 to close the price gap. Now let's look at this overall structure from a candlestick perspective, and you'll see how brilliantly candlestick analysis actually allowed us to identify very specific turning points within the overall Elliott wave structure. What we have here clearly is a bullish engulfing pattern. Now, one thing that I've learned personally, and I'm sure Steve's spoken about this, is notice the bullish engulfing pattern. Sizable move to the upside. Why would this engulfing pattern be more significant to me than, say, perhaps this bearish engulfing pattern? Would anybody take venture a guess? I'm sure Steve has mentioned this at some point. Joseph, good answer, but I'm looking for something more specific. Nope, not yet, TJ. Nope, nope, nope. Okay. One of the observations I've made utilizing Japanese candlestick analysis, and specifically with the engulfing pattern or formations, the more candles that are encompassed by the engulfing bar or by the engulfing candle, many times that candle is going to be much more significant. So if I have a bullish engulfing pattern that encompasses simply the previous candle, so it's going to be, reliable, I'm going to pay attention to it. But if I've got an engulfing pattern, bullish and or bearish, that encompasses, as you can see right here, 1, 2, 3, 4, 5. It encompasses about a half a dozen different candle bodies here. Very, very significant. So I see this as very, very important. Then up here, I forgot to put this on the top, but notice we have a dark cloud cover formation here. Also, too, notice the very long upper shadow. Again, the market is rejecting the higher prices. Now, this little formation where you have a bullish engulfing pattern followed by a bearish engulfing pattern, but more specifically the bearish engulfing pattern, notice that prices didn't continue lower. They didn't fall below the lower shadow of that bar. What we did instead was we actually rallied back above the high of the candle. This is what I refer to as a failed bearish engulfing pattern. Sometimes a failed bullish engulfing pattern like you see here sometimes occur. Why is this significant? Well, it's significant because what I've learned as a trader over the years is sometimes the best buy signals are failed sell signals, and sometimes the best sell signals are failed buy signals. So whenever you have a bearish engulfing pattern such as this, the implication is that the direction of the market will be lower for the next 3 to 5 periods. Well, that's not what happened. Okay, well, if that's not what happens, something else is going on. And usually that something else is going to be that 3 to 5 bar price move or candle move in the opposite direction. So I like to pay very, very close attention to these, basically are these typical bearish reversal formations utilizing candlesticks that don't work out. Because when they don't work out, that means something. That's a clue. The market is giving us a clue. And then we have another failed bullish engulfing pattern here. Again, bullish engulfing pattern, the market should have gone up. It didn't. It was immediately followed by a bearish engulfing pattern. So we have our A, B, and then what's really nice, notice the move to the downside. This is our ending diagonal. What formed here? A nice, significant, very significant morning star formation. So again, very, very clear. I think I'm doing okay on time. Let me just go to a few more price charts. I saw a comment earlier having to do with the shorter term time frames. Does it work on the shorter term time frames? I believe so, and I'm going to show you some slides I was working with in the U.S. bond market. But I wanted to just show you some very recent price action. I've had a lot of fun this week with the SPY. This is one of the markets I sometimes trade. And what I was really excited about the other day, and I'll wait for this chart to load up for you guys, was what occurred, well, this was Friday, that's Thursday, Wednesday's trading. Okay, notice what happened here. Clearly we had a gap to the upside, okay? Well, in Thursday's trading, notice we had, on the open, we saw a small gap to the downside. Now, at 9:30 or even 9:40, there was no guarantee that the market wasn't going to continue higher, but I was kind of thinking that, hey, we've got this gap up, low shadows here. I like that. Nice resistance. I like the downside here because of the gap lower, because the end result would actually be an evening star formation, which, as you well know, is a very bearish and also very very reliable Japanese candlestick reversal formation. So with that in mind, say about 9:30, 9:45, certainly by 10 o'clock, my focus in the S&P is really to the downside because of primarily the candlestick formations that we've seen this past week. Okay, so with that knowledge in mind, I tend to be a trend trader. So what I want to do is move to the smaller time frame. This is a 10-minute price chart of the S&P, or actually the SPY. The SPY is simply an ETF that tracks the S&P 500, as we all know. Now, my primary focus here, number one, we saw the gap down. That was occurred right here. This was the gap lower on, I believe, again, Thursday's trading. But one of the things I want to do initially is put my trend lines on. I'm a big fan of trend lines. If you're not utilizing trend lines in your work, you need to. For such a simple tool, it is extremely effective. And remember what I said earlier about how counter-trend price action tends to be contained within parallel lines? Well, here we have a move to the upside. Clearly a three-wave structure to the upside in the SPY. This is a 10-minute price chart. But now let's zero in right here on this area. Okay, so I'm going to expand the chart. So one of the things, so as far as market clues, again, sometimes I view technical analysis or chart reading as a language. The more you learn the language, the more you can understand the story that the actual price charts are telling you, regardless of whether it's a, say, open, high, low, close price chart, or even the price chart of the SPY, candlestick price chart here. So we know that we have a gap up, red candle, then a gap down. So we're potentially working an evening star reversal formation. Thus, I'm inclined to be looking to the downside as we move into Thursday's trading. So my thought process around, say, 9:45, 10 o'clock is for, let's look for a selling opportunity for further decline. Then we see this move develop. And again, this was about 11 o'clock. We rally up, move higher. Clearly a three-wave price move, so this is wave A, wave B, wave C, and then I like this formation here because you have actually a few different candlestick patterns that I like to look for. Number one, these three candles, this one, the next one, and then the next one, that's what I refer to sometimes as that three inside down reversal formation. Then, if we look more closely at this price chart, notice the real body here, the real body on the subsequent candle, and then the real body on the third candle. Of course, everybody knows what this candlestick pattern is. This is a three black crow formation. The real bodies are expanding in the direction of the larger trend. So this was essentially a great selling opportunity. You could have actually entered the market, say, selling the market on a break below the low of the green candle, a break below the low here, or even a break below the low here. The stops, either a stop here or the prior candle. Notice the shaven tops as well. Again, that's also very supportive of further decline in the downward direction. And then later in the day, of course, we had a number of bearish engulfing patterns as well. This was a very easily identified, I think, selling opportunity Thursday. And again, this was about maybe 1:30. Had to simply be patient, but again, it was clean and clear. What were the two tools that helped me arrive at that conclusion? Well, simply put, the two primary tools I was working with was the wave principle. This is a three-wave counter-trend move. This is, well, if we look at an open, high, low, close price chart, it's actually a zigzag. It's a 5-3-5 pattern. So that was my tool. Also, too, the move to the upside was indeed contained within parallel lines. Again, that's more of a concept of the wave principle, and also another technique that I do, something called the Kennedy channeling technique. I don't know why it is, but as a technician, we tend to like to name things after ourselves. I know I do it, and I know a lot of other friends of mine who are in the business, they like to do that as well. But it's a simple trend line technique that helps you identify Elliott wave patterns a bit more clearly, and this is a key characteristic of that. Counter-trend price action tends to be contained within parallel lines. So, that being the case, The wave principle essentially argued the move was going to the downside. That move, that view of a move to the downside was confirmed and supported by our candlestick analysis. Also, too, our candlestick analysis, again, in conjunction with the Elliott wave principle, allowed us to identify really the best trading opportunity, in my opinion, of the actual day, and that was to actually sell the peak here right at about 1 o'clock. And as you can see, it was a decisive move to the downside. I tend to trade day trade options, just by the way. So I was taking advantage of this price move from an options perspective, buying, say, I think I picked up some 218 puts. But if you're a futures trader, you easily could have been trading the futures market, and this still would have been a very handsome trade to the downside. So again, I combine the wave principle and candlestick analysis all the time. Here's just now some recent work I've been doing with the U.S. bond, for example. In fact, if you are interested in some of the work that I do, usually once or twice a year I host it's about a 2-week-long webinar series. It lasts 2 weeks. We get together for like a webinar, 1 or 2 hour webinar every day, like 3 days for 2 weeks in a row. It's a lot of fun. I do one in the fall and then in the spring. And what I call the series, or what the webinar series is titled, it's called The 4 Critical Elements of High Confidence Trading. And the 4 critical elements, I'll just tell you exactly what they are. Number 1, trend. I like to focus on trading in the direction of the trend. That's my trading style. So in an uptrending market, I like to buy pullbacks. In a downturning market, I like to sell bounces. Then I focus on pattern. That's number 4. That's the second critical element. First critical element is trend. Second critical element is pattern. And when I say pattern, I'm talking Elliott wave patterns. The impulse wave, the diagonal, the zigzag, the flat, and the triangle. Then I look at momentum. I put a lot of value in momentum because just as price exhibits pattern, momentum also exhibits pattern. For example, a bullish or bearish divergence is a type of momentum pattern. And each wave pattern certainly has a very specific or sometimes unique momentum pattern as well. So, for example, if I'm looking at, in this case here, possibly waves 3, 4, and 5, I would like to see bearish divergence in price and an underlying indicator or oscillator, for example, RSI and or say stochastic. And then finally, the 4th critical step, can anybody guess what the 4th critical element of high confidence or high probability trading is? And remember, I've been doing this for quite a while. I've got 4 critical elements. Number 1 critical element, trend, pattern, momentum. Nope, Gene, it should, I agree with you, the importance of risk management, but no, it's candlestick analysis. Because with candlestick analysis, I can fine-tune my trading. In many instances, like for example here, I have a 3-wave decline, waves A, B, and C, right to near the previous 4th, bullish engulfing pattern. My entry most likely is going to be the high of the upper shadow. My initial protective stop is going to be the low of the shadow right here. There's my risk. Again, one of the reasons I'm so passionate about candlestick analysis is that I can actually identify the risk on many of my trades to the range of a single price bar. In my opinion, that's exceptionally valuable. I can identify very precise levels to actually enter a position, and also I have very precise levels to actually trade against. So candlestick analysis, very, very important, and I certainly applaud Steve and his work at the Candlestick Forum, because as I mentioned earlier, the field of technical analysis has a number of very reliable tools and disciplines and techniques. And the ones that I've, as a technician for 20 plus years, I've pretty much looked at most of them. But I've only selected a few that I work with in my forecasting and in my trading. And Japanese candlestick analysis is one of those disciplines. And I think it combines or is able to coexist quite nicely with the Elliott wave principle. In fact, I think by combining the two distinct disciplines, you're going to actually improve your market forecasting as well as your trading. Just my 2 cents or my thoughts. Well, I see I'm at the point where I need to stop talking and actually ask you some questions. So I'm available. If you have a question, let me have it, and I'll do my best to answer it. The yellow box. Okay. Notice on this chart in front of you, you'll see a yellow box. Okay. The software I use actually has a highlight bar function, and what that highlight bar function does, it allows me to identify very specific candlestick formations. So what the yellow box is actually doing is simply alerting me to the fact that this is indeed a bullish engulfing pattern or perhaps a bearish engulfing pattern. It's a simple little feature of the software platform I'm using. Peter, what kind of software can incorporate all of this? Well, the platform I'm utilizing is a very basic platform. I've been utilizing it for a few years now. It's called not Traders Classroom, that's my service. It's called Trade Navigator. With Trade Navigator, I'm able to utilize price charts such as open, high, low, close, and I can label them with my Elliott wave labels. Now, the labeling that you see on these price charts, this is manual. I'm looking at the price chart and I'm determining where the labels should go. There are some software packages out there, or there are some pieces of software that will actually label the Elliott waves for you. I've worked with some of those, and I've yet to really be impressed. So I label all my waves, all my wave patterns, all my price charts. I label them myself. But again, this software, Trade Navigator, allows me to utilize an open, high, low, close price chart as well as a candlestick price chart, among a number of other features. You may be familiar with, say, for example, TradeStation, Market Analysis, Ninja. You can pretty much do much of the same thing. Ray. Are Elliott wave patterns only exhibited by trending stocks? No. I use the wave principle on, for example, the euro. The euro appears to be working a contracting triangle since the early low that we saw in 2015. So that's basically a weekly price chart right there, and that's a FX market, currency market. We were just simply working with the SPY. That's an ETF. We were looking at 10-minute price charts of an ETF. This is the bond futures. This is actually a continuation price chart of the T-bond, the 30-year, looking at 60-minute as well as 15-minute. The wave principle works, again, across all markets and time frames. For example, just as candlestick analysis works across all markets and all time frames. But I will say this, I tend to prefer the candlestick formations. Let me slow down a bit because I don't want to confuse anybody or misspeak. If I'm working on a daily chart level or higher, then I love to see this. I put a lot of importance on, say, single bar or single candle reversal formations. For example, the bullish engulfing pattern, the bearish engulfing pattern. On the daily chart level, love to see them. On the weekly chart level, even more so. The larger the time frame, the more significant the actual candlestick patterns actually be. For example, a morning star formation on a weekly price chart is going to have a little bit more juice to it than, say, an evening star or morning star formation on an intraday price chart. When I get to the intraday level, I really prefer to see the multiple candle formation patterns, such as a morning star. So if I'm working on the smaller time frames, I'd like to see a little bit more, a few more candles involved. For example, on that 10-minute price chart that we were previously looking at on the SPY, we had a 3 black crow formation. Well, we have 3 candles to work with. Doug, great question, Doug. Thank you. Are Elliott waves continuous, or do they break down and need to restart at some point? Elliott wave patterns are continuous. The wave patterns that you see on, say, for example, this price chart here of the U.S. bond, wave patterns form larger and smaller versions of themselves. For example, if you were to take a look at, say, for example, sugar, as the editor, as the chief commodity analyst at Elliott Wave International, we've been working a contracting triangle in the sugar market since it began trading. and I have wave patterns, wave labels to designate the actual triangle. But that's on the quarterly chart level going back multiple decades. But as you move forward in time, those wave patterns form larger and smaller versions of themselves. So we simply start with that big picture analysis and work our way down to the, again, intraday timeframes. More questions? It does appear that a recording will be available, guys. Trevor, let me see, the first SP chart, the hammer to the left. Let me see if I can find that chart. Oh, this one right here. Basically, the way I interpreted these two candles specifically was it really seemed to me that this one right here was very much of a stop running move. And what I mean by that is if, okay, we put in a top here, this really looked like a legitimate evening star formation. Then we trade sideways and we go up and we simply take out the prior high. This looked like nothing but stop running. Gary, Ikumoku Cloud. No, I do not utilize that. In fact, I know very few people who are truly skilled at that approach or that technique. When it comes to analysis, I like my stuff simple. I focus on basic Elliott wave patterns. Again, the 5 core Elliott wave formations, the zigzag, the flat, the triangle impulse wave. I think I still have that slide on this page here. Let me try and find it. I just simply focus on the 5 core formations and keep it simple. Even my candlestick analysis, there's only about maybe a half a dozen I tend to focus on and lose the rest, because as what's very important to remember is, and this may be worth writing down, I don't know, there's a big difference between doing market analysis and doing and trading. Big difference. Just because you're a great analyst doesn't mean you're going to be a great trader, and just because you're a great trader doesn't mean you're an exceptional analyst. They really require 2 different skill sets. As an analyst, my job is to identify possibilities, probabilities, what could happen. This could happen, this could happen, this could happen, and then rank those possibilities and say, okay, of the 3 or 4 choices that lie in front of us as far as, say, the direction of gold, this one is most likely. That's my job as an analyst, okay? So in other words, as an analyst, my primary focus is on what could happen, okay? Well, as a trader, my focus is on, well, you guessed it, making money. So as a trader, my focus is on what is happening, okay? And as a trader also too, we all know you have to be somewhat results oriented, okay? So that being the case, any approach I use, any discipline I use, number one, I want it to be simple and I want to make sure it works. Hence, this is why I use Japanese candlestick analysis. This stuff works, okay? Very, very much so. And more importantly, I think it works quite well when you combine it with the wave principle. And there are a few indicators and oscillators that I do use. I think I have 1 or 2 slides to show you just a few things, or maybe I deleted it. If I did, I apologize. But RSI and stochastic is one of my favorite tools. I really like this signature. Well, in fact, I'll just give you, we're kind of winding down. I just want to give you one little freebie, okay? And let me try and find a market. What's somebody's favorite market? First one to give me a market or individual stock, we'll look at it. HD. Okay, Gary, you were quick on that one. Ticker symbol is HD. Okay, and let's go to a daily time frame. Remember what I said earlier about momentum patterns? Just as there are patterns in price, there are also patterns in momentum. Okay, well here is, let me see if I can find a good example of it. Give me just a moment. It's a very precise pattern, and it's one that whenever it comes up, I almost always like to trade it. Let me go to the 60-minute time frame. And again, I apologize if the screen, well, here we go. Here it is. Okay. I was fortunate enough to learn much of my RSI application from Andrew Cardwell. Now remember, RSI was developed by a gentleman by the name of Wells Wilder, probably one of the most, if not brilliant, technicians of our time, since like the 60s, 70s, and 80s. The man's absolutely brilliant. And he developed RSI. Now, Andrew Cardwell kind of took his work and evolved it and made it somewhat, well, actually not somewhat, but very, very useful from a trading perspective. Of course, everybody knows George Lane. George Lane popularized stochastic. This is my signal, and I love looking for it. If you're utilizing RSI, the range or the area between 50 and 40, this is what we refer to as RSI bull market support. So if you have an advance, your counter trend movement in price should hold, RSI should hold that range of 50 or 40. Okay, so what I like to look for specifically is for RSI to be in that 50-40 area, and at the same time, look at my stochastic, it's an oversold. This is almost a gimme. This is telling me clearly, mathematically, that this is a counter trend move and most likely is going to be a buying opportunity. So that being the case, I can either identify that possibly as a fourth wave pullback or a wave 2 pullback. But number one, I know it's a counter trend price move within a larger uptrending market. This is the momentum, one of my favorite tradable momentum patterns. And again, it's just a freebie for you guys. Start looking for it. And it doesn't, again, matter it doesn't matter what market, it doesn't matter what time frame, intraday, daily, weekly, doesn't matter. Now, what would be even more exciting, to get back to the topic of tonight's presentation, look for this momentum pattern. Again, RSI falling into and holding that RSI bull market support area between 50 and 40. At the same time, insist on stochastic being in the oversold area, and then possibly right here, you see a morning star formation, a bullish engulfing pattern, a 3 inside up formation, some type of bullish candlestick formation to confirm that the counter trend move is complete and the larger uptrend is back in force. Okay, guys, that's about it. I think I've got maybe 2 minutes left. Gary, would I buy RSI if it goes above 50? Not necessarily. I want to see the structure. I want to see the price. I want to see a candlestick chart. Okay? Well, guys, thank you so much for letting me share with you a little bit of my work, what I do. Again, my approach to the markets, forecasting as well as trading, tends to be very holistic. I simply don't like to limit myself to one technique. It's kind of silly. It's like going to a buffet and only eating one item. Technical analysis is a very rich and diverse field. It has a lot to offer the analyst and trader. The wave principle I find great value in. Japanese candlesticks I find great value in. And I really find an increase in value when I do indeed combine these techniques because they corroborate one another, which is exactly what I want. So that's about it for me, guys. Thank you so much. I really appreciate it. So Steve, back to you, or Becky.
Jeff, thank you. Sorry I wasn't here in the beginning, but a lot of good information, everybody. So Jeff, we appreciate the presentation. A lot of good information in here.
Thank you, Steve. I appreciate the opportunity.
All right, great.